In this video, we're going to look at the impact of leverage on risk and the cost of capital. So in their first proposition, right, the very first concept, Mediglia and Miller 1, right, in this proposition, they basically used this concept of leverage to derive a relationship between leverage and the equity cost of capital. So remember, if you have no debt, then the cost of financing to the company is the same as the equity cost, because that's the only kind of financing that you have. So here we have some variables, right? E is the value of equity, D is debt, U is the market value of equity in an unlevered firm. So in this case, as the market value of equity in a levered firm is the market value of the debt in an unlevered firm. And again, in this perfect capital market, we've said that they're the same. That's equal to the market value of the firm's assets. So the total value of the firm's security equals the market value of its assets, whether the company is levered or unlevered. So the impact that this has on the cost of capital, right? The return on unlevered equity, R sub U, is related to the returns of levered equity and debt, right? So the cash flow from holding unlevered equity can be replicated using homemade leverage, right? So if you don't like the leverage or the leverage position of the company, you can incorporate your own debt portfolio. So that's what this is: the company unlevered, and this is your debt. You would end up with the exact same unlevered equity cost of debt. Again, this is with respect to this perfect capital market, though. If you solve for R sub E, you have the return of the company without leverage, and then you can add your own capital structure, right? Your capital structure times the difference between the return without leverage minus the return on debt. So the amount of premium, right, the amount of excess return you get depends on the amount of leverage. And that obviously it comes from the debt equity ratio of the company. So here we had this other company from another video, right? If it's all equity finance, the expected return of the unlevered equity is 15%. If you decide to finance with $500 of debt with the expected return of 5%, how does that affect the cost of equity? So 15% is the unlevered equity return. Now add that to the debt equity value. Again, this is 50%, right? So it's $500 of debt. Then you multiply that by 15 minus 5, right? So that gives us what? 25% is the end return of equity. If you remember, that's exactly what we got in a previous video. So R sub U is exactly equal to R sub A, where R sub U is the unlevered equity cost, and R sub A is the cost of the assets that you have. So market value, risk, and cost of capital for the firm's assets and equity are the same. So that means that in the end, they are equal. So the weighted average cost of capital, right, if the firm is levered, right, that in a world that with perfect capital markets, I keep repeating this, I understand, but we have to understand that that's why this is a little strange, is because we don't live in this world. Because of this, we basically have no change in the costs. So the weighted average cost of capital equals the return on unlevered equity, which also is the return on the assets of the firm. So again, just to kind of reiterate, right, with perfect capital markets, weighted average cost of capital, the cost of financing, is independent of its capital structure. So its equity cost of capital, if it's unlevered, matches the cost of capital of its assets, right? So it's the fraction of the firm's enterprise value that corresponds to debt. That is what we refer to as this debt to value ratio. So graphically, what does this look like? Here is the debt cost of capital. Again, for certain relationships, I guess you say the debt doesn't change very much, but if you do start to borrow a lot more money, cost of debt does increase. And we can see here that as you borrow more and more money, the equity cost of capital itself increases. So when you combine the two of these, what we end up with is a weighted average cost of capital that is unchanging. So if we put this in context of a formula, the value of the firm equals the free cash flow of the company divided by the weighted average cost of capital. If the weighted average cost of capital doesn't change, and if we assume free cash flows are fixed, right? Cash flows don't change based on the capital structure decision. If this doesn't change, then the value doesn't change. So V sub L in the end, sorry, I need to get my drawing mechanism working here. Oh, wrong pencil, sorry. V sub L equals V sub U. And you'll see this a couple of more times before we get into adding some of the other peculiarities, if you will, of capital structure and making this decision. So with no debt, the weighted average cost of capital equals unlevered equity. That makes sense. As the firm borrows at the low cost of capital, equity cost increases, and it rises in such a way that it directly offsets the lower cost of debt. So equity goes up while you're changing that into a lower debt. So the net effect is, again, weighted average of cost of capital does not change in this perfect capital market. See you in the next video.